Raise a hand, unmute yourself, interrupt me in some way, and we'll be happy to stop and take any questions that we have along the way. So today we promised to talk about the formula and the only formula for successful investing. We will talk about the difference between investment and speculation. We'll talk a bit about some definitions like risk, return, and liquidity. And then we'll look at various asset classes and how one invests in these. So there was a question, and I wanted to come back to this because there was a question in the chat that Kurt asked last week about investing, about living in one place and spending money in another place. So if you're, saving money in some place and you're living somewhere else, then what happens and what can the effects of inflation be, given the fact that you might be kind of spreading your life across two places? And I wanted to tell a story that kind of reflects something that actually did happen to me and how that played out. So if you imagine, for example, that you decided in 2004 to buy a car in Colombia and you spent 30 million Colombian pesos on that, which at the time was $11,000. And then you left 3 years later and sold the car for 70% of what you bought it for at 21 million pesos. The question is, how much did you actually lose in that transaction? And I did the math on that to show what can happen when you kind of import a currency and then export a currency again later at some other time. And what happened was the car's purchase price in dollars was 11,700 and something, and then the sales price in dollars when converted back into dollars was $10,700. So that's a relatively small amount to lose on a car that you have driven for 3 years if you can sell it for more than 90% of what you paid for it. And that is, I think, a case in which it can be very lucky if you move money from one place to another and then move it back at the right time. But you can't predict that anyway, and there's no way to predict that. There's no way to know how that will work. So I ran the numbers the other way and said, what would happen if the exchange rates had actually been different? If I had to, I had no pesos, you might not have that currency of the country you're going to. So if by moving to Colombia, you have no choice but to buy pesos, and when you leave, you have no choice but to sell them and take your money back home and put it back into dollars. And if that had happened the other way around, if the exchange rates had been inverted to how they actually played out, then the loss in Colombian pesos would have been the same. The car would have been resold for 70% of its purchase price, but the loss in dollars would have been more extreme because the cost to buy the car originally would have been far higher, and the dollars that were recouped when it was sold and the money was shipped back essentially to the US would have been much less. And I don't think there's any way to really there's not any way to really know which direction currencies will fluctuate. So this is a risk that everyone takes when they invest in one place and when they live somewhere else. The best direction and guidance that I have seen has suggested that you should invest in a place that's close to where you live. So if you're planning on having a European retirement and a European future, then it would make sense to invest in Europe and not in the US, because you would mitigate that exchange rate risk between, let's say, the value of the real estate and the stocks that you're investing in and the value of the currency in which you are likely to spend your money. But if you are investing internationally, or if you're investing in, let's say, dollar or euro denominated things, and if you're living in some other country, then you always face an extreme risk of fluctuations in currency and the changes in the amount of purchasing power that you would have as a function of that. I'm sure Frank from Mozambique knows the extreme fluctuations that have happened in Mozambican currency as well. That the currency has been both very expensive and very cheap at various times, and there's nothing you can do about it when you live in Mozambique. It's just one of those difficult risks, and something that we have to accept and then try to mitigate through how we decide to invest. So that was just coming back to Kurt's question. So now coming back to what we wanted to talk about today, we discussed last week the present value and future value formulas, and I sent around some, I don't know, some practice questions and some things. I don't know if anyone has had a chance to look at those, or if anyone has any reflections on how that worked, or on the topics we covered last week. Now would be a great time if anyone has anything they'd like to raise about that. Was there anything that didn't quite make sense, or that we have questions on from what we discussed last week? Great. In that case, let's move forward. So yeah, that's what we covered last week, and then we were talking about investing, and this week we were talking all about investing, kind of in broad terms, and we'll go into the details of some of the asset classes and those kinds of things in the future. But here's the kind of broad overview. And generally, in this course, of course, we're talking about investing for our financial futures, and investing in physical things like money and real estate, and those kind of material wealth. But there are other ways to invest as well, like in our education, in our own capacity, in the networks that we have, and it's also possible to invest in things like our health and our well-being, and anything we think will bring us a benefit in the future. So in addition to investing with money, we invest our time, we invest our attention, and we invest our work and our effort and things that we do. For the purposes of discussing our financial futures, there's a goal of investing that some of us, I think we all have, even if we haven't maybe articulated that or decided what exact dollar amount or shilling amount or metikal amount that is. But I think most of us would agree that over the course of our lifetimes, and now we're all young and working, our goal is to either build enough wealth so that we can retire as soon as possible. So basically, we're just here to make money, and once we have enough of it, we could stop working and not have to worry about, the future. Alternatively, we could say that, we know that we have a working life and we expect to work until a particular age, maybe 60, maybe 65, maybe 70, maybe longer. But our goal then is to try to earn as much as and amass as much as we can for our own future, maybe for our children and their well-being, or for whatever else. In either case, our goal is really, as we see this curve, to try to get this goal, this red circle, as near to us on this axis as possible. So as short as we can, or as soon as we can, we want to make as much and earn and amass as much as we can. So bringing this goal closer to us in time and higher in eventual financial value. Keeping that in mind, our goal is then to build this curve, to create something that allows us to have the best curve we can. And the best curve is the one that's the steepest and the sharpest. And one thing you have to be careful about, and this is something that I learned a bit the hard way, is not to accept this red curve if you haven't seen the yellow one and the green one. So someone might present to you some investment option and say, look, here's something, you will make more money, you will amass wealth, it is compound growth, you'll earn more over time, and your wealth will accumulate, and it's great. And it sounds great, but then if you realize that it's really not that great, because there are other things out there that are far better, then you realize that that maybe what had been sold to you as the solution to your problems was actually pretty weak in comparison to the other options that you might have had. So I think what all of us really want to do is to look for the optimal curve here, the one that can safely and with minimal risk help us amass as much value in our portfolios as we can, and the sooner the better. So we go back to the future value formula, which is what we discussed last week in order to calculate the future value of an investment. And this is a reminder of what it was. And by the way, when we look in the, and we look at this again, an example of $100 that's invested at 5% interest for 3 years, we remember that if we were only earning simple interest, then we only would have expected to have $115. But because we have amassed interest that has then become part of our principal, and then that growth has compounded, we've noticed that that wealth has increased and increased on top of itself. So those additional 76 cents that you would have after 3 years are the results of that compounding interest. And even though 76 cents doesn't sound very much, over the course of a much larger portfolio and over the course of 20 or 30 years, that becomes a significant way for us to accumulate wealth beyond just putting money into an account and not expecting it to grow. So reminding ourselves the basis of that formula, there are really 3 variables, right? So the future value is affected by those 3 things that we saw in this formula. So the present value, the interest rate, and the periods. Because of this mathematical equation, we know that increasing any of those while leaving the other 2 the same would increase what it's equal to, the future value. So putting different words into this equation, we see this: the amount that we invest, the interest rate we can manage on our investment, what we can achieve, and the number of periods are what will help us amass wealth. So really, this is the formula that helps us understand basically how to get to that goal, is to maximize these 3 variables: either the amount invested, the rate of return that we get, and the length of time. And here in graphical formula, you kind of see that. So to move this curve up to the highest point here that we can, we want to start from the highest place we can, which is showing us that, the more we start with, the better off we will be. And of course, the more often we add to our savings by, like, every month, continuing to invest, then the length of time that we invest over. So starting when you're 20 is far better than starting when you're 40, for example. And then the rate of return. So the steepness of this curve is determined by that percentage point, which is determined by the rate that is earned on the investment. So this shows that, again, invest more, start sooner, and get better returns. And that's what's going to bring this circle to the highest point and as soon as possible as can be achieved. And then finally, avoiding any unnecessary risk, of course, which we won't cover in too much detail probably this week or next, but later on we'll talk a little bit more about that and the diversification of portfolios. So practically, how to do that is the following. And these things they're all obvious, they're generally common sense, but to maximize the amount that we can save and invest, we of course have to either try to earn more money, take home more pay if we can, spend less of that on things that we need here and now so that we can save more for the future, and then try to get as much as we can out of compound returns, because that compound interest, that interest that we get this year can then become principal that we can invest and use in the future years, and that will also then generate its own returns. Secondly, optimizing returns, so investing as aggressively as it makes sense to do without being reckless. That means probably investing in stocks instead of all bonds, especially when we're younger, because the returns are higher, there's a little bit more risk, but over time and in general, that's a better way to get to where we would like to be in terms of having an overall rate of return. Avoiding fees, that's a huge one. We saw, I think, last week about just a small 1 or 2%, how the impact that a 1 or 2% fee can have on the total amount of a portfolio after several years. And then managing risk, diversifying and reallocating between investment and asset classes, which we'll talk about later. And then lastly, and I think maybe most important, especially for all of us who are still pretty young, invest for as long as possible. So the sooner that you put money away, the sooner you start getting those investment returns to begin to compound, the farther along you will be later in life. And you can see that because the growth is exponential, because the returns compound upon each other, that is, our investment portfolio grows at a curve and not at a line, meaning that every year, the slope of that curve is steeper than it was the year before, meaning the longer you wait, and those last years are the ones that where the growth is the most. And in order to get to those last years, you either have to continue to work long into your life, or you have to start sooner. And if you have the option, being young, to start sooner, then now is the time to make a decision to start putting some money away and having that later, because there's no substitute for time. That's the exponent of the formula, which is the greatest place to have leverage and impact on that equation and on the result of the future value in the future. So quick definition so that we don't get off track. An investment is, by definition, an allocation of money or something else in the expectation of a future benefit or a future return. So you put something someplace, or you direct some effort somewhere, or you spend some time doing something because in the future you expect this will have a future benefit for you. Generally, the benefit should be in the terms of the thing that you invest. So you invest money in the hopes of recouping more money in the future. That is different from speculation, which some people will confuse. But speculation is where you kind of take a gamble and you expect that something is going to increase in value, or someone is going to come behind you and want to pay more for something, or you think that, let's say you think that a house in a certain neighborhood will appreciate in value like crazy, and so you go and you spend all of your money buying 3 or 4 houses there because you just have a feeling that that might happen. And then 10 years later, you actually can't sell those houses because that never happened and nobody actually wants to live in that neighborhood. And you're lost and you're behind. And that's because you speculated on that investment. You didn't actually invest trying to get a better return. You just expected that the price would fluctuate in your favor, and you took a gamble. And then you may or may not win on that. But in general, that's not a good way to build an investment plan on speculation.
Hey, Daniel, one question.
Sure.
What do you think of crypto then? Do you think crypto is
hoping,
speculation or
glad you asked,
investment?
but I have no response on that. I was thinking about that, and I don't know enough about it to say that it doesn't make sense. A lot of people seem to be investing in it. I don't really know. I don't know what its value is, or who is going to come along in the future and want to pay more for crypto than someone has to pay now to buy it. There's always a risk that something is kind of a Ponzi scheme where someone buys into something and then someone comes back encouraged to pay more for it, and then those people think that this is an investment and that it's really generating more money, and then that contributes to the hullabaloo, and another round of people come in and want to buy something, and then they do that, but then suddenly there's a bubble, right? And then suddenly people start to realize that the value of that asset or investment or whatever it was isn't really that high, and then the bottom falls out of it, and then the last person who paid the most for it is the person who ends up holding the bag and isn't able to recoup the investment, whereas all the people who bought and sold it up until then did really well. I really have no idea whether crypto is in that category or whether it's something that people will generally decide to exchange for. For stuff.
No, I totally agree with you.
Yeah,
I totally agree with you, because
I'm too ignorant to invest in it myself. That's what I'll say.
Crypto to me is not tangible enough. So
neither is money. I mean, we all accept money. It's a social construct, right? Where we accept that money has value, and we all continue to believe that money will have value. And because everyone believes that, it does. But the moment people just stop accepting that, it stops having value, and then you would wish that you had something else. But I don't know. Interesting things, I think.
Yeah. Thanks.
Kazi.
I'm just thinking, in terms of investment and in terms of the retirement plans, there seems to be an underlying assumption that things will get better in the long term, right? That's why we invest, because we expect things get better, we get better return. But if you take away 20th century, that has not always been the case. The data indicates otherwise. However, that should not, as lots of people will say in the investment area, that past data is not indicative of the future. That makes a lot of sense. But I guess the key assumption here that we're making is things will get better, and there's a lot of emphasis on technology, right? And I think I don't know what is the implication of this, but I think it's good to at least be aware of our underlying assumptions that are permeating when we communicate, because that can help us make better decisions.
So we do assume that things will get better, and we assume that like economies will continue to grow and money will continue to have value. We also know, you remember that the thing we looked at in the first thing we looked at was the creation of money. Basically, when someone loans out money and then someone else creates value and is able to sell something else, and then there ends up being more money in the economy. I think that helps us remember the point of investing, right? Because if people can take money, whether it's a loan or whether it's an investment from stock or whatever, it doesn't really matter, but from shares. But if people can take money and then buy a few things and put them together in a different way and then create value and then go back to the economy and sell those things for more money, then there is a need for people to invest, right? Because the people who are doing that work don't always have all the capital that they need in order to continue that growth. And so by us investing in things, in real things, right? Things that, if you invest in, I don't know, Apple, and they can hire technology people and they buy whatever they need for their phones, and then they make more phones and they sell more phones, like, they're adding value to people's lives. And they're doing that maybe on the back of the money that they have received from selling shares. And that's kind of how the economy works, right? So there is that assumption that people will continue to need that funding, that money. So they will continue to need money from people who already have it, which is why we can invest in them, and that they will continue to create value, and then they will come back. And the other assumption is, of course, that they will come back later and pay dividends, or pay back their debt for bonds or whatever else, and then that the investors will benefit. There's always I suppose there is always the chance of like global meltdown and long-term recession and just an economic collapse. But if that were to happen, then there's also no real answer to what you should do with your money, right? Because if suddenly money doesn't have value and nothing else has value, then also that's a bigger catastrophe, which I suppose could happen. But
I'm not disagreeing. I think what is interesting is like we have built systems and structures which ensure that these things get managed better. So I think, as you said, diversifying your portfolio, and one thing that would be kind of helpful is to look at different jurisdictions as well. So if you put all your eggs in one basket, so if, for example, I put all my investment in Bangladesh, there's a huge risk. I'm assuming that the people, the government in Bangladesh will be able to manage it really well 50 years from now. Right, and it's the same thing. The question is, there are capital controls. I mean, there's a lot of stuff that comes into play, but we need to be careful that spreading our I think investment pot in the most optimal structure might not give us the best return, but it's a kind of risk contingency plan that we need to figure out. So yeah, that's all I was
definitely. Most definitely, and we'll talk about that a little bit later when we talk about stocks. We'll talk about stocks, bonds, and then the other stuff, and then we'll talk about how to diversify a portfolio for the to maximize returns while minimizing risk, which is an important and critical thing. Sure. So the definition of return is the profit or loss that we derive from an investment. And when people talk about their investment, then of course the next question is, what is the return? And often the return is described in terms of a percentage. So it could be, I invested in this and I got 7% per year over time, or the S&P people will talk about when they talk about the American stock market has generated returns on average of 8% or 9% or 10% per year. But you could also talk about the investment return after a number of years, like after 10 years, I had doubled my investment and that was my return. Risk is the other side of an investment, which is the chance. Risk is, of course, the chance that things won't turn out the way you expect. So risk is the chance that the returns will be different from what you expect. And risk can always be positive or negative. Generally, people don't talk about positive risk, but there is a chance that things will be too good. But when we talk about investment risk, we're generally talking about what will the chance or the probability that you will invest or that you will be able to recoup less, or that the returns will be less than you would expect or that you would want. Then liquidity. So liquidity generally means the degree to which an investment can be turned into cash, or how quickly that investment can be turned into cash. So cash is by definition liquid because it is cash. Things like stocks and bonds are extremely liquid because you can, if you have your stocks on, some online broker, then you can go online, you can sell your stocks, and immediately or within a day you have cash. Real estate is less liquid. Some types of real estate, like let's say a house or a condo or an apartment, would be more liquid than something like a shopping mall, because a house would have more potential customers and be more likely to be able to be sold than something like a shopping mall that would only have maybe one or two potential buyers who would be interested. And then something like art is relatively illiquid, that you really need to find the one or two people who would actually want to pay cash for that. And it might take you months or something to be able to change that investment in your portfolio into cash. So that's an illiquid investment. And then tax, we all know what tax is. It's something that's unavoidable. And it's something we have to pay to the government, and it's something to keep in mind because our investment decisions and the gains that we make may be taxable depending on where we live and where we invest. So it's something not to be forgotten or ignored. Then, when we talk about reasons to invest, there are generally two reasons why someone would invest in something, or two ways to kind of typify the gains from that. The first would be the expectation that owning that thing will increase in value. I think that's why you would invest in crypto. Like, I'm going to buy it so much now for so much, and I'm expecting that in the future I'll be able to sell it back and get more stuff for it than I would have been able to do keeping my dollars, for example. And then, or I'm going to buy a house now and I don't really care what happens in the meantime, but 10 years from now, I expect I'm going to be able to sell it for more. And then the second reason to invest, or the second way in which we can earn money from an investment, is the expectation that we'll be able to get profits from owning it while we own it. Investing in a stock, for example, will yield dividends, or investing in real estate could yield. Actually, I have a table here. Investing in real estate could generate rental income. So here we have the asset classes that we will talk about today, and the types of benefits that we get from them, both the profits that we get over time. So from stocks, we receive dividends on a regular basis. From bonds, there's a coupon payment. Often real estate, when you invest in your own home, you might not get paid for doing that, but you might avoid having to pay rent to a landlord. So in that way, it still is generating a return for you. Having a rental property, of course, you will get rental income. And then for some other investments, there's actually nothing that you can get from them over time. Like if you invest in gold or some metals, that just sits there, yields no no dividends or anything. You just have to wait until the time that you sell it and hope that it has appreciated enough that will make up for that. And then the value at the sale date basically is, for a stock, it's the price of that. For the bond, it's what's called the face or the par value, which is the value of the bond. We'll talk more about that in the future, but of course, if you sell a bond before its date, then obviously you will sell it for its sales price, the same you would for a stock. And then for real estate and for gold and all the rest of that, it's the difference in what you paid versus what you sold it for. So, so those are the two reasons. And I think maybe both for Kai and Kazi, going back to the questions, like if you're investing in crypto, then, you know, if you invest in these things, you can kind of see why they have some value, because if you're investing in a stock, you're providing a company with access to capital so that they can create value. If you're investing in a bond, you're doing the same thing, except it's debt. If you're investing in crypto, then, you know, where is your money going and why? And what is, if that's an investment, how is that generating value for anyone at any point? I think would be the question. And if you can't really answer that, then you might say, actually, maybe this is more like speculation than it is like an investment. That's just a thought. So any questions now before we start looking at these in more detail? Great. So stocks, let's talk about stocks. Stocks are what I think, you know, I don't know where we're starting from in terms of knowledge base for all of us, but I know from my own experience that while some of this information is basic, it's not something that people ever really tell us about unless we go out and study it. So just starting from the basic building blocks of information here, when you own a stock, you become a partial owner of the company in which you have that actual stock. And some people will talk about, you know, owning stock and owning shares. That's because stock is sold in shares, and those shares are pieces or slices of the company that, you know, that they're held in. The money from an initial sale of a stock goes to the actual company. So the way that a stock works is that a company who needs capital will issue stock in a sale, either an initial sale like an IPO, they call it, initial public offering, or there can be further sales of stock later on, and the company can also eventually buy back its own stock. But basically what happens is the company needs money and realizes they need money for investing in their company or for whatever, for the operations of the company or the growth of it. And they go to the market and they say, we're going to sell shares of our company to the public, to anyone who wants to buy it. And then we will take that money and we will incorporate that money onto the balance sheet of the company. We will spend it and use it and invest it. And people who are out there who have bought that stock will own pieces of the company, and we will pay them dividends so that they benefit from owning parts of the company. So that initial stock that's been sold to the general public will be sold to these institutional investors first, and then it will go out into the general public. And so if you get online and you look at, you know, one of these online brokers, you can go and you can buy one stock or thousands of stocks, thousands of shares of any company that you really want to at the price that it's selling today, because there are generally people who are willing to sell that at a moment at the price that it's at now, and there are other people who are willing to buy that. And if the price of people who are willing to sell or willing to buy changes, then automatically online that is what changes the willingness of people to sell at a particular price is what changes the sales price of that stock. And thanks to things like technology, there's, you know, we all know instantaneously how stocks are trading, the price at which stocks are being bought and sold. And then the rewards for owning stock are, of course, the dividends that the company will pay out. So over time, every quarter, every year, whenever, the company will make a decision and will decide that its shareholders should each be paid so much. And those dividends are generally small, like cents or a few dollars at the most, but it's not a ton of money. But because that company is a going concern, we expect that company will last a long way into the future. And because those dividends will continue to come in, it's considered valuable to own that stock because that guarantees you your share of those dividends over time. Then the other, I think, principal type of investing in a company is bonds. And when you own a bond, you are buying debt from a company. So the company issues bonds saying, it's the opposite of a stock almost, saying we need money and we will, give us your money now and we will give you particular pieces of money over time. And then at the end of the date of the bond, at its end date, maturity date, they will give all of the money back plus whatever at the face value, right? So the company will say, let's say, for example, there's a $1,200 bond. They might sell it for $1,000 plus a coupon of so many dollars at so many points along the way. And the company promises to make those payments, and the company promises to pay a certain amount at the end of the life of the bond. And the company goes out to the market the same way that happens with stocks. They go out to the market, they sell that, and once the company has sold that, then individual investors can trade those bonds and those stocks between each other. So in the case of a stock, if you have, the first person who went, that institutional investor went and bought that stock from the company, that means that their money went to the company gave them a share. But after that, those shares have been trading among normal people, and they have been exchanging money with each other. So if I have a stock of Apple and I sell that to Lewis and he sells that to Kazi, nothing happens at Apple, and Apple might have no idea who the actual shareholders of their company are. What happens is we decide on a sales price and we agree to trade that stock between each other based on what we want to buy and sell. More on that later, but the same also happens with bonds. So once that bond has been issued by the company and the company has received its capital, the change in price of the bonds between individual investors doesn't affect the company one way or the other. That company has, will agree to pay its coupon, will agree to pay the value of the bond, but what happens between other investors who are trading that bond is only between them. And then the second thing, so the price of the bond, and this will also come back to the future value formula. The price of the bond is influenced by the face value and the coupon amount, the creditworthiness of the company or government who issues it. So not only companies, but also governments can issue bonds like treasury bonds, savings bonds, and then interest rates on the market, and then its time to maturity. So the question based on that is, when interest rates increase, what happens to bond prices? Would anyone care to wager a guess?
When prices increase, yield drop.
If interest rates increase, what happens to the price of the bond?
Interest rate increases, the price. The other way around. Yeah, price increases. Yeah, so price goes up, yield drops, yield goes up, price drops. Price drops.
Yep. Why, Kazi? Does anyone disagree? Does anyone want to know why? I'd like to know why. Can you describe it? Kai, would you also like to know why?
Okay, sure.
Yep.
So because the face value is fixed, right? So it's like $100. So at the end of the period, you'll get $100. If the price drops, then the return you get at the end of the period goes up, right? And if the price goes up, then the return at the end of the period goes down because the amount you receive at the end is fixed. Now in between, so it's kind of, there's complicated calculations that factor in the coupon rate and blah blah blah. But the key point is how much money you're putting in, how much money you're getting out back, and that's where the issue is. Does that make sense? Like very vague, very broadly speaking.
Yeah. For whom does it not make sense?
But I thought that when you subscribe to a bond, the let's say interest rate is already fixed.
Yes, the yield, so the coupon rate is fixed, right? But the value of that changes because we have to factor in the present value, right? Because it's a future coupon rate that's paid next year or the year after. And the question is, how much money are you paying to get that rate? So for example, if you were paying $100 to get a $100 bond, then 5% is the return you will get if the coupon rate is 5%. So say a coupon rate is 5% and you invest $100 for a $100 bond, you're making 5% on the bond. But if you are actually buying the bond for say $90, then the yield goes up because you have the coupon rate plus the fact that you will make $10 extra, factoring the present value in at the end of the bond period. Does that make sense?
Yeah, agree. Thank you.
Sorry,
Kai, were you able to follow him? Because I've told Kazi before that he's able to talk a lot faster than most people can think.
Sorry, my bad. My bad.
Lewis, do you understand?
Yes,
Maybe
I follow.
left. Are you following?
Yeah. Yes. Thanks.
Good. Okay. Yeah, it's that's more articulate than I could have described it, Kazi, but that's the point. And it's the function of that future value formula again, but kind of in reverse, because that future value is already determined and it will never, that company is never going to pay back more than the face value of the bond. So if they've said it's $100, then that's what they're going to pay back. So as interest rates change, then the price of that bond trading today will also change. And if interest rates increase, then that bond is going to get cheaper based on people's willingness to buy it. And like you said, to get that rate of return. So that's a fun exercise. Then something else, and maybe we could also put crypto in here, maybe it needs its own slide, but metals and alternatives and other things that people invest in. So gold is one and maybe the most common. They derive their value from the fact that they're scarce. In the past, countries have tied their currency to actual amounts of metals. That's, at least in the US, that's no longer the case, but that was the case before. Again, you can own gold and it's not going to do anything for you. It's not going to pay dividends. It's not going to provide you with rental income. You can only hope that in the future you're able to sell it for more than you bought it for, and hopefully that it appreciates more than the rate of inflation, because otherwise it really wouldn't really have earned you much. Yeah, and then we just hope that it will continue to increase in value. Now we're going to talk about mutual funds and exchange traded funds. So a mutual fund is a basket of investments that are sold as a unit. And mutual funds can be made up of assets in any class. Often they'll be made up of shares or stocks or bonds, but you can also have precious metals, mutual funds, or really anything else. When an investor invests in a mutual fund, they can buy several things at once. So you buy one share of this mutual fund and you have exposed yourself to the ownership of a number of underlying securities that someone has put into that fund. They're priced on the net asset value of the funds, meaning that they're priced every day. They can only be bought and sold once a day at the end of the day. They can have various areas of focus, like a geography, a sector, what company size, whatever. But the important thing about a mutual fund is that they are actively managed. So this fund that you end up buying, if you're buying, let's say, shares of, let's say it's a mutual fund on shares of biotech companies, there's a manager who is managing those funds, who's trying to make sure that the returns in that fund are as good as possible. So that person is responsible for deciding what the makeup of each share of that fund will be, meaning that person is being paid to do that work, and that person is also making decisions, buying things, selling things, to keep them in that fund. And all of the people, of course, who own shares of that fund will own similar proportions of the same underlying thing. All the shares within that mutual fund are the same. But that person, like I said, is the one who's being paid to manage that and to select what's going on inside that fund, which is different from, let me skip ahead past this one, to an exchange traded fund, which are relatively new in the market. They've only been around since about the early 90s, but you will hear a lot about people investing in exchange traded funds or ETFs, and ETFs are things that generally follow an index, and generally they will follow an index like on the stock market, so such as the S&P or the Dow or something else. We'll talk a little bit about indexes in a second, but exchange traded funds are passively managed, meaning there's not really a person who's there deciding how to build this fund, deciding how much of each underlying asset to put into it. There's just a computer or some algorithm that is deciding that each share of this fund, for example, will contain the same thing as is contained in the Dow Jones, which is 30 companies, or the S&P 500 or Russell 3000 or something. So there doesn't need to be a lot of management fee going on this, because that computer makes a lot less than a person would. And there's a lot less trading that goes on day to day in terms of buying and selling the underlying assets. That asset manager who's managing a mutual fund will be buying and selling and trading and doing a number of things that cost money to do, and then incur taxes when those are done for the investors eventually, because all those costs have to be passed on to the people who are investing. Whereas when you're investing in an ETF, those funds can be bought and sold automatically. They'll be bought and sold less often, triggering less tax events and less management fees, meaning ETFs can be sold, can be provided at a rate that is much lower than mutual funds. So they're cheaper to own. We'll take a minute now and go to what an index is, because I think that's an important thing, and because so many ETFs are based on index. So you will hear the Dow Jones, like I mentioned, S&P 500, Russell 3000. There are other ones, FTSE for the UK. There are other ones for other countries also. But generally, these are a proxy of indicating what is going on in terms of the total health of the market. So people, rather than tracking everything that's going on in the stock market, they track this as an indicator. So the S&P is, like I said, 500 companies. Dow Jones is only 30, and it's 30 really large companies. So it's not terribly representative of the whole market. But it's a way for people to recognize quickly what is going on in the market. So Dow Jones now, I think, is at somewhere around 35,000. It wasn't that long ago. It was at 25,000, and people follow that, and it helps us all to understand generally what's going on average, while the values of the individual stocks, of course, that make up the market are going up and down independently and in general, but it's a general indicator. The stocks that make up an index can be decided based on a mathematical equation, like the Russell 3000 is 3,000 largest stocks. However, they can also be chosen by people or by a committee. So Dow Jones is the Dow Jones in the US, which is probably the number that most people know and follow, is actually not decided by that. It's decided by a committee. A committee gets together and has decided which are 30. They're not necessarily the largest. They're 30 influential companies. And on occasion, they switch companies in and out of that index. And not all of the companies who have stock in that index have the same percentage weighting in that index's number. So again, it's a proxy and it's an indicator, but it's not the only piece of information that you would need to know what's going on in terms of the stock market. But if you invest in an ETF that is directly tracking one of those indices, then you can be sure that when you check the Dow Jones online or something, you can be sure that your investments are going up and down just the same as that index. And because that index exists and it's already known, there's no mystery of what's there. You don't need an asset manager to decide how to place investments within that. It's automatic, and a computer can do it. And is what happens within an ETF or an exchange traded fund. And then two more, and then we'll wrap it up. So how I got screwed was investing in an insurance product, which I didn't realize was an insurance product. But what can often be sold to people is so-called long-term savings plan, which is actually an insurance product. Insurance, by the way, should in general only be used to guard against risk. So if you think, your house might burn down, you should have insurance on your house. If you think your car might get in an accident or you might crash your car, you need to get insurance on a car. You shouldn't get insurance as a pension plan or a savings plan. There are annuities, which are similar to an insurance policy, where you accumulate for a number of years a certain amount of money, and then after a certain point, that money, you have that annuity built up, you essentially have an endowment that then pays you during the annuitization phase, pays back out a certain amount of money to you over time. In terms of saving money and investing, these are just generally not good things for us, and buyer beware. And then REITs, finally. So REITs are real estate investment trusts. They are similar to a mutual fund, except they allow people to invest in properties. And several, like in the US, for example, things like shopping malls or large apartment blocks or those kind of things can be held by REITs. And the individual investors, you might not have enough money to buy yourself an entire commercial office building, but by investing in a REIT, you can diversify your portfolio by investing in a piece of one or a piece of several properties through this investment. The returns are positive. Of course, yeah, like any property, returns can be variable. And the taxation on REITs, I know for Americans at least, the taxation on REITs is different from taxation elsewhere. So you have to be careful how you invest in those, and in which, if you have tax-free accounts or taxable accounts, you have to be careful where you place those. But it is, in addition to real estate, which many people will own as homeowners and potentially as owners of rental properties, REITs are a way to expose yourself to real estate risk without actually having to own a property and worry about tenants and get a phone call when something breaks and whatever else. So there's those two options as well. So that was kind of an overview of these general asset classes. In the next couple of weeks, if everyone is interested to continue, I think we can talk about those in more detail. But I thought for now, the important thing to discuss today would have been that curve, and understanding that our path to wealth is basically charted by those three things: by how much we're putting away, by how well we are getting returns on those without excessive risk, and then for how long we are able to invest, meaning starting as soon in life as possible if we haven't started already. So perhaps I will stop there and open it up for a roundtable, for chats, for anything anyone wants to talk about.
Hi, Daniel. Frank here.
Frank.
Thank you.
Frank, you can turn on your camera. We can be social.
Okay, I can do that.
Others as well, if you don't mind. I mean, it's nice to get to know each other.
Okay, hi. Yes, I have a question. If you could just develop a bit in regards to stocks. Could you please develop how do stock buybacks work? Because it's a term I hear a lot and not usually in good context or as a good thing. So I would like to understand more how do they work, and do stocks are stocks available every time to be bought, and how does that stock buyback work in general? If you could please develop it a bit.
Yeah, so I mean, how a stock buy in simple terms, how a stock buyback works is a company decides that there are more shares, they have cash and there are shares on the market, and they want to take that cash and go out and buy those shares back. I mean, that's maybe obvious because that's the definition, but they go and they buy these shares back. So they pay, if you're an investor, let's say you have shares in Apple and Apple decides to have a stock buyback. If you agree to sell your share back to Apple, then you can do that, and you will sell it to them basically at the same price that anyone else would buy it, because otherwise you would hold on to it, wouldn't you? You wouldn't. There's a trading price for that share. Let's say it's $15, and if Apple comes and says, "Hey, we're going to buy back so many shares, we're going to," they will pay what anybody else would pay. Otherwise, you wouldn't sell it. So then, if you're interested, and only if you're interested, you can sell it back to them. They then own it, but the company can't own itself. So the company then has those shares. That does not necessarily give them voting rights or the ability to. It dilutes the ownership of the company in that those shares are no longer owned by other people. So now the company is owned by fewer shareholders, but it doesn't give the company the rights to kind of own itself, as it were. There are different reasons the company can buy back its own stock. In terms of, I think the financial, sometimes it's signaling, I think, and sometimes I think it's around the actual bottom line of the company. If they have money and they think the stock price is not in the right place, then they can take shares off the market by buying it back. They could also buy back shares if they want to change the number of people in the general public who are owning shares of that company, in order to eliminate maybe being taken over by people who are out there and trying to buy more of that stock than they're comfortable with. But generally, it just means the company buying shares off the market of itself by paying the investors the cash value of those stocks, and then deciding what to do with them. And those stocks can either be decommissioned, or they can be canceled, or they can be held and then later reissued onto the market. And I guess, when they're reissued on the market, they'll be issued at the price at which the company can get for them, which would be the trading price. Because if you're out in the market and if you want a share of Apple, you will, you won't pay more to get it from Apple than you would to get it from someone else. So they will have to sell that at the same price as at its trading price. Does that make sense?
Yeah, it does. It does. Thank you.
Was there a second part to your question?
The other part, I think I can rephrase it, is there a point where no stocks are available to be sold in a particular company?
Well, I mean, generally everyone has a price, right? And so I suppose in theory, it could be the case that no shares of a company none of the investors wants to sell their share in a company at any price, but that's not very likely, right? Because were you with us the first week, Frank? I think you were with us last week, right?
Partially, yeah.
Partially, yeah. So we talked about discounted cash flows, and we talked about return on investment, and we talked about a house that you would buy, and then what do you get for it in the future? The sensible price to pay for a stock would be, you have to think when you're buying that stock, like, why am I spending money on this, right? Am I spending money on it because I think I'm going to sell it for more later? Or am I spending money on it because I think that owning this stock is going to give me dividends, right? The company's going to pay me dividends over time, like over the next 10 years or 15 years. So therefore, it makes sense for me to put my money here because this is going to be cash cow, right? That over time is going to pay these dividends, which I will then continue to invest in other things. So the sensible price to pay for a stock is the discounted value of all of those cash flows in the future, right? If I say, what are all the dividend payments I'm going to get from now until eternity, and then discount those based on an inflation rate or discount rate at the inflation rate, then I say, well, this would be the sensible price to pay sensible amount of money to put into this stock, right? So knowing that, right, it's highly unlikely when the price of a stock got higher than that amount that nobody would be willing to sell their stock, right? Because you're saying, is it possible that no one would ever buy it? And if that Apple stock is now trading at $15, it's not very likely that all of those investors who today think it's worth $15, if someone says, I'll give you 16 for it, they'll say no. And if I'll give you 20 for it, I'll say no. And if I'll give you $1 million for it, they'll say, at some point they will sell, right? Everyone will sell. So it's theoretically possible that nobody could engage in selling, but because things are being bought and sold at a price at which they're deemed to be valuable, it's highly unlikely that that would not happen. Does that make sense?
Yeah, but that brings, I think for me, another question is if stocks are stock numbers fixed, or who decides if a company should or not increase the number of stocks? Or
the company themselves decide, right? Because they went to the market with a certain number of shares, and they said we're going to sell this many shares of this company at this price, and then people buy it, and then immediately, like you often see when there's an IPO, the initial public offering, they've decided the share price, they've offered this stuff, people come in, people buy those shares, people give that cash to the company, and then the stuff goes and starts trading, right? And then the price can go up or down. Like let's say, you'll hear it on the news. Oh, in initial trading, this price dropped by this much or that much, or it increased by so much. And there's often this giant leap and fluctuation where people are buying and selling like crazy until the stock price gets to be a more established number. So the company will decide, and then they will sell those at that price, and then those shares exist in the market. You can also have a stock split where the company can decide that it will split its shares. And often if the price gets to be really high and prohibitively, like if it's not liquid enough because nobody wants to spend $500 on one share of a company, the company can mandate a stock split, meaning they will divide, but you won't really gain or lose any economic value or ownership in the company, because they will divide it by 2, and then they will also divide the value of it by 2. So rather than having one stock for $10, you'll have 2 stocks that are each worth $5, but then you can decide to sell half of your ownership in that company. So in that way, the company can also decide to double the number of shares, but that doesn't really change
the amount you own. Okay. Yeah, thanks. Yeah, I think it's clear. Thank you, Daniel.
Anybody else?
Daniel, what do you think about education insurance? I've seen people taking those for as a way of preparing to pay for their kids' school fees in the coming years, in 10, 13
I have no
years
idea.
or
What
so.
what are they insuring against? I mean,
Well, it's just a form of savings. It's just that it's for education. So you invest, you pay, for instance, a certain number of money per month for 11 years, for instance. And then in the 13th year, you start to get payment back that goes into children's education, for instance, when they grow up. But it's a gray area for me. I don't know.
I mean, I think, is that a thing that's being sold in Kenya? Yeah, I have no idea. But I think if I were going to the company who was selling that, I would say, why is this an insurance product? What are you insuring against? And what, insurance, like I said, is something against risk, right? Your house burns down, you need insurance. Your trip gets canceled, you have travel insurance. This sounds like it's a long-term savings plan, meaning they're asking you to put in so much money every month for so many years, and they're going to give you back so much money at the end of that, right? And based on what we discussed last week, you can ask them that question, and you can make the table, and you can say, how much money am I putting into this thing every year for the next 11 years? And then how much money am I getting out when it matures? And what is the rate of return on that? And what kind of fees are you charging me on this savings? And where is this money going to sit when you have it? Like, what are you actually investing it in? Or are you just parking my cash and not giving me any returns, right? Those are the questions you could ask. And based on what they tell you, you would know whether it makes sense to actually invest in that, or do you just open a separate bank account and discipline yourself, or ask your employer to just put so many dollars or so many shillings aside for you every month until you're, oh yeah, there's a kid on the way, right? Don't forget to update us when that happens. But until, you know, kid is ready to go to school, and, you know, you'll know whether you really need them to administrate this money for you, or whether you can do it yourself. All right.
Hello, I have a couple of questions. One
it's
is,
gonna be,
what's the difference between passive funds and ETF? So like I was looking at passive funds, and you know, under the trading structure, you have funds and then you have ETFs, right? So I can't basically make the distinction. They're both done passively, but I don't know why there's different elements of charges there too. So that's one thing.
you said passive, sorry.
Passive funds. So you have
Passive.
active funds, passive
Yeah.
funds, yeah. What's the difference between passive funds and ETFs?
I don't think that's a thing that there's a difference about. An ETF is generally something that is a passively managed funds. So you have funds, they're actively managed, meaning someone is the guru who's saying, let's do this,
Yeah.
let's do that, let's buy, let's sell, let's what. And
Yeah.
then on the passive side, you have something that says, we're investing in the S&P, and there's like a computer that's reading what's in the S&P, and that fund automatically buys that. And so that's passive. It's just
Okay.
totally automatic and algorithmic. And
Okay.
ETFs are a type of passive fund.
Okay, cool. Because the reason I'm asking this is because when you look at the cost structure for ETFs, they're quite low. You can get them at like 0.07%, 8.08%. Whereas when you switch to funds, which are still passively managed, you can get up to say 7%, but then you have other charges, and then you have the stock holding charges, which actually add up to about maybe 0.5 or up to 1%. So there is these variations that come into play. So if they're fundamentally the same thing, then there's no reason why you need to pay more for the same stuff, right?
Right.
And that's what I was thinking. And the other issue that I was thinking about is how do you manage temperament? Because like when you're investing,
How do you manage what?
temperament, like so as an investor, how do you not lose your cool, like go crazy? So if, for example, if you had an investment, like, you know, you were doing your 401k or your investment plans, say in 2019, things were hunky-dory, and suddenly the pandemic hits, and then the stock market drops by 30%. A lot of people panicked, right? And what is your advice in terms of your experience? Like, how did you manage through these kind of turmoils?
Well, you need to be zen about it, right? The way to manage it is by putting your intellect in charge of your emotions, which is the same as it is for everything else in life, right? And you have to look at, the first thing you have to do is, and this is, I only know this from like advice and books I've read, but the first thing you have to do is make sure that you are not investing more aggressively than you can actually stand to do. Because when that inevitably happens and you start losing money in the stock market and you see the portfolio value collapsing, if you sell then, you know, if you've bought when it's expensive and if you sell when it's cheap, that's absolutely the worst thing you can do. But as you start, you know, when things start going down, then of course you're in fear of a free fall, and then it's going to go lower, and it might go lower. And if you sell out, you really risk not being invested through the whole market cycle, and then you risk having to wait until it's even more expensive when you start buying it back. And it's a gut-wrenching thing, I think, to have to go through. I was kind of lucky that I wasn't a very savvy investor during the last crisis, so 2008, 2009. I didn't really know as much as I knew now. So I was kind of invested then in like basically bonds, and it was a relatively poor rate, but I missed that whole negative rate basically. So we'll see how much gut strength I have when eventually the market collapses, but it's going to happen, right? The price to earning ratio, I mean, stocks have essentially never been as overpriced as they are now, if you take price to earnings ratio, right? So like you can expect that there's going to be a correction and that it's going to go down. And if you look at the value of your portfolio, you say it's this much, and then tomorrow it's going to be not that much, and it's going to be less. But what you have to understand, and it's only education that can do that, is that being invested through entire market cycles is the best way to eventually get wealthy, right? Because really what's like, I have a job and I'm going to have a job for 10 years or 20 years or whatever. So I don't really need that money that's in that portfolio. So if I log on and it says, you know, I have $10 or I have $10 million, it doesn't really matter to the here and now. Like I have to go to work and I have to save money, and it doesn't really matter. What's going to matter is like 2045 or whenever I decide to retire, right? So you have to intellectually remember that that's your goal, and you have to understand that there are going to be ups and downs that might make your stomach hurt in the meantime, but that is mathematically and in terms of historically, the way to amass wealth over time. And the other thing you have to remember is that, like, if stock prices take a nosedive, that means that they get cheaper, right? So it means all those things that you have saved up until now look a lot less valuable. But if you, and this is what Warren Buffett said all the time, like, you know, if you are interested in hamburgers, then you would only be happy when the price of hamburgers gets cheaper, right? And if you're investing, then the best thing that can happen to you now is that things actually do get cheaper. So if the stock market takes a nosedive tomorrow and the prices of everything goes down, it makes what you have amassed until now look a lot less valuable. But the silver lining to that cloud is that all of the things that you would want to buy while we are now in this this working and accumulating phase of life, it's cheaper, so you can actually invest. But so it's that, it's not doing more than you can stomach, and then trying to be a little bit intellectual about it. And I mean, you know, you can't log on and look every day and say, oh, I gained this much, I lost that much. Oh wow. I mean, you know, that can be rather nerve-wracking.
Exactly.
The science, I mean, the history proves that doing minimal corrections to your portfolio and just keep plowing away and sticking with it is in long, and we'll talk about that later. But in terms of the long range vision, that's the way to get there.
Cool. It's easier said than done. No, sure. I think everyone says this, but it's so tempting, and it's not an easy feeling. It's tough. But yeah, if you can master it, then you're set. Yeah. Cool.
Nice. Anything else? Any feedback for me so far? Like, is this useful? Is this helpful? Is this interesting? Should we continue? That's my question to the group. Yeah. And or is like, I don't, you know, I don't know the kind of baseline we're all starting from. So is it too high level, too deep, too basic, too anything? Any feedback from all of you? Anybody? Okay. I'll assume it's all right then. Right. Okay. Hey guys, thanks. Let's wrap it up here for today. Thanks very much. I plan to be back next week at the same time. So if it's good, then let's talk again then. Yeah, have a good week in the meantime.
Thank you, Daniel.
Bye.
Bye.
Thanks. Okay. Bye.
Bye. Thanks.
Thank you, everyone. Bye.